By most accounts, McDonald's is a winner in the restaurant industry. It was able to generate remarkable profitability results for 2024. In the fourth quarter of 24, McDonald's operating margin was 45% and the net profit margin was 31.5%. That is really remarkable for an industry where a 30% margin is more than double the average rate. And McDonald's was able to reward its investors with a higher dividend, which made investors pretty happy. McDonald's paid $1.77 quarterly dividend in quarter four, and that resulted in an annual dividend of $7.08. So the dividend yield of McDonald's of 2.23% is again the double of the average dividend yield for S&P 500. So that's the good news about McDonald's. The investors are pretty happy, and despite some shaky results in Q1 and also the economic situation that's going on, McDonald's is very well positioned to weather this economic storm, which should be good news for franchise owners. And I'm sure you've heard these factors and you must be reassured by them. So first and foremost, McDonald's has the brand and the pricing power to raise prices as necessary to counter inflation and rising costs. Not 100% obviously, but they're more so than its competitors. A really good thing about the McDonald's supply chain in that it's minimally affected by tariffs by having so much of the supply chain be local to the United States. And the brand recognition, pricing, tariffs, and its ability to hedge the currency and just be a financially well-managed company will help McDonald's do better than its competitors and still remain a strong company. So that's the positive for the system overall. But you may be looking at your own economics and not seeing the same type of profitability in your own results. And that is understandable because McDonald's profitability is driven by different factors than yours. McDonald's charges royalty fees and rent regardless of what your sales are and also regardless of your own margin. They don't charge you any less because your costs are going up and you're suffering or you see a real decrease in your cash flow or your profitability. So that's the difference between what McDonald's is able to achieve based on your hard work and what you may be able to achieve based on the same work and what in your pocket, in your wallet, and in your wealth this year and beyond. So in this situation, in these conditions, what is it that I as a financial coach, as a financial advisor recommend that McDonald's owners do in the next couple of years? The first thing I think is very important is the mindset. The shift in mindset around expectations of your results and what you should be focusing on in your business in the next year, 2 years, even 3 years. It's very tempting, it's very logical to look at what has happened and what's been happening in the past years and compare to your expected results this year and maybe not be happy because the past has been so good and the positive trend should be continuing to keep building and expanding your business and also accelerating your growth. But that may not be in the cards. With the current economic situation and the fast moving news and the bond market reacting to the stock market and the stock market being in a disarray, it may not be the best thing to just look at the past. What I recommend is actually reframing your expectation and re-benchmarking of not past on your past results in some kind of a growth rate, but actually looking at your business, where it is now, and what are your main goals, and what is it that you need to do in your business, what kind of operating results you need to achieve so that you can still achieve your own personal goals based on your business. And the second thing, so one is the mindset. And the second thing that I recommend is really paying attention to your profitability. Take it from the McDonald's example. They're very hyper focused on the numbers and making sure that their margins are up. And so should you. Look at your profit and loss, look at your results, look at your numbers and see line by line, what are those ratios, what are those numbers, what are those benchmarks, what are those standards that you need to track and to follow to make sure that your results are adequate and that your results are in line with the economy and then you're still achieving positive growth and meeting your goals. And it's always tempting to think that everybody has this covered, you should be able to come up with these results and you know what all these results look like. But in my experience, that's not always the case. That's why there are 3 ratios that I wanted to mention just to make sure that you're tracking them and you know what they are. The first ratio I recommend is the prime cost ratio. And this is a very important metric for restaurant operations. It looks at your cost of goods sold, COGS, and your labor costs, and it compares it to your total sales. Basically, what you want to make sure is that your prime costs, mostly your food and labor costs, are 60% or less of your total sales. If you see something way above, that's a cause for concern, then you need to reevaluate your labor and food costs and make sure that you reduce them. If they're less than 60%, then you're in a good shape. The second ratio that I recommended you look at very carefully and very closely is your net profit margin. If your profit margin is less than 10%, then that is again a cause for concern. Anything over to 15-20% is amazing and it's great. And you should know that you're in a good shape to move forward and to continue your profitable business. But if you see numbers that are less than 10%, then again, see where some of the challenges are and how you can improve that number. And third ratio is your break-even cost. What does it take for you to make sure that you can cover your fixed costs, and what level of sales do you need to generate in order not to lose money? So this amount will be just the minimum you need to make, and once you have that as a benchmark, you can ground yourself in that is the minimal expectation that you can have, and then layer on top of it all the other goals that you have, whether it's paying off debt or expanding or actually meeting some of your personal goals. Maybe your kid is going to college, you want to buy a house, whatever it is in your life and your business that you need to generate, at least you'll know the floor and the bottom off of which you can build. So again, if you have these ratios covered, keep going, you're doing a great job. But if you have not looked at these results or you don't consistently review them with your CPA or your CFO, please reach out. I'm happy to make sure that you have the view of those ratios, and most importantly, what actually those ratios mean for your business, and what are the 3 most important action steps you can take this year to have the type of business and life that you want.